Okay, fantastic. We're just going to wait for a few people to sign in, I think. Okay. I think we're getting a steady flow of people in. I think I'll just quickly begin and say welcome, everyone, and thank you for joining us today on this webinar that we're proud to co-host with Calculus Carbon. And this webinar will be around investment, risk, and policy insights in carbon markets across the global south. So we are anticipating that this will run roughly for 45 minutes. So we'll do like 35 minutes of presentation, and then we'll do a 10 to 15-minute Q&A. So I will first introduce AlliedOffsets, and then I'll get into some policy insights, some market trends, and forecasting will come later. We'll also hear from Calculus Carbon, who have been working on case studies demonstrating transaction structures, risk management, and investor outcomes as well in the voluntary carbon market. So I think without any further ado, I think maybe we'll just go ahead and start off with the first slide. Next slide, please. Okay, perfect. Thank you. So now, just quickly about us. We are AlliedOffsets. So we are a data aggregator. We are based out of London, UK, and we are looking at the entirety of the voluntary carbon market across all countries. So we're looking at about 35,000 projects in our data set every day. We're looking, and that's across 18,000 buyers of carbon credits. We're also ingesting about 16,000 price points every year or so, and we're also tracking the number of credit issuances, retirements, and also price transactions that are occurring in the market. My name is Fundi Mapanga. I'm the policy lead at AlliedOffsets. So I've been covering everything around the convergence of voluntary and compliance markets, around Article 6, CORSIA, and I'm here to hopefully start off this session, and then we can continue into the broader investment trends later. So next slide, please. So very quickly on market trends. First slide, please. We have been looking again at voluntary carbon markets across the global south, and we understand that the global south is the beating heart of the VCM. About 85% of all projects on our data set are located in projects within the global south. We are seeing 521 CCP approved projects. So these are including the projects that have received an approval label by the ICVCM and their core carbon principles. And we're also tracking the issuances and retirements of these credits. And we're seeing that there's been a tightening of issuances this year, where we've seen 33% lower than 2024 issuance values, but then we're also seeing a slight uptick in retirements, just by 3.8% higher than 2024 at 39 million credits. In terms of the offtake segment of the market, which I think is relevant for this conversation, so offtakes being the forward purchases of credits by investors and project developers to bring those credits to the market. We're going to hear a lot more about investment structures, but broadly in terms of where the data looks at it, we're seeing about 1.4 billion credits from different project sectors that are currently under an offtake agreement in the global south. And then in terms of projects with integrity criteria by location, we're also seeing that the majority of these project activities are located in the global south, with one or two exceptions in the UK where we're located. Next slide, please. And then broadly, when we look at the investments into the VCM, we've been looking at what are the broad trends, and we've seen 2024 marked the high point in terms of investment volumes into the VCM. We saw $3.6 billion invested in terms of the approved capital, I suppose, into these project activities, and that discounts the $7 billion US in terms of US dollar investment that could also be included. We've taken that out, so right now you're seeing that figure of 3.6 as the peak without that value. But with the 7 billion, it would reach up to 10 billion US dollars. And then offtake agreements, we started to see that the offtake market has started to increase as we're seeing more and more of these deals being structured. And around about 40% of retirements in the VCM in last year, or this year, relative to last year, have come from offtake agreements. So it is a growing segment of the market. It does make sense that there's looking to be different ways in which we can catalyze capital into these voluntary carbon market project activities. And that also follows along the policy trends as well, which I will get into next. Next slide, please. So broadly, what we've seen across the different regions is a development in carbon trading regulations, being able to set clear rules of the game, and also in terms of some markets, the opening up or reopening up of the voluntary carbon market. So in the case of Indonesia, we've seen the presidential regulation 110, 2025 replaced the previous presidential regulation and lifting the freeze of that carbon market for international export. We're seeing India start to formalize its carbon markets with the structuring of the CCTS, or the compliance scheme in India. We've seen methodology being published and also revised by the government of India as well, the Ministries of Environment. We're seeing Japan as well announce its mandatory compliance scheme, which is set for launch next year in 2026, which targets 100 million tons of credits via the joint crediting mechanism by 2030. We've seen a host of bilateral cooperative agreements being signed this year and also last year. But this year, Singapore signed 8 of those agreements, taking their total up to 26 agreements, 8 of which have been signed and finalized. And then we also starting to see new entrants such as Thailand signing its first agreement with Singapore, which is the first bilateral agreement in Southeast Asia, Vietnam as well. And then in terms of the implementation side, we're starting to see project activities being approved for the Article 6.4 mechanism. In Myanmar, we've seen Indonesia start to sign cooperative agreements with independent standards such as Gold Standard, Vera, Global Carbon Council, Plan Vivo. We've also seen a host of countries submit initial reports to the UNFCCC. And we're starting to see more and more of that Article 6 readiness come to fruition. Next slide, please. And then equally across Africa and EMEA, we're starting to see the same trends around the maturity of the market around the carbon trading regulation. So Kenya and Zimbabwe outlined their draft regulations and regulations for their carbon markets. Ethiopia, Malawi, and Nigeria have published Article 6 framework documents, which allow for clarity around how projects can be authorized towards Article 6. The UAE has published its regulation that came into effect in June. And so we also start to see bilateral agreements similar to the Asia Pacific, where Rwanda signed a bilateral agreement. Mali, Mauritania, and Niger have started to formalize agreements with Global Carbon Council to build national registries. Kenya, which is a party and a member of the Coalition to Grow Carbon Markets, published shared principles and a plan of action yesterday. We've seen Saudi Arabia being able to structure regulations around and deals around the voluntary carbon market space. And then also on the implementation side, we're starting to see concrete action where Ghana's transferred its first ITMOs, the first in Africa, to Switzerland under Article 6.2. Zimbabwe has correspondingly adjusted its credits to first in Africa as well this year. We're seeing more and more countries issue letters of authorization that are showing up on registries. And also we're seeing countries publish Article 6 update reports in the case of Malawi. Next slide, please. And then finally on Latin America, we're looking at a broadening of the policy and regulation and also warming to international carbon market trading under Article 6. So we're seeing Brazil set up publish its decree, which creates a carbon market secretariat to implement the ETS, and also looking to formally publish a Article 6.2 policy framework. Colombia has published a tax reform bill, which proposes the doubling of the carbon tax rate and reducing of the offset limit. Cuba has published regulations to define the carbon trading rules under voluntary and compliance markets this year. We've seen a host of bilateral cooperative agreements. Again, I will mention a couple in Chile, Peru, Dominican Republic, and Paraguay. And then we've also started to see direct implementation on the ground. So we're seeing Chile authorize its first 6.2 project and a biomass facility to replace coal, and then Peru also establishing its joint committee with Singapore to publish the eligibility requirements for project activities to use their credits towards the Singapore carbon tax. So there's been a host of activity on the policy side, and we're seeing some of these bottlenecks start to be addressed slowly but surely. Next slide, please. And when it comes to the individual market segments, we're seeing with Japan that there is an implementation of the joint crediting mechanism. So it has bilateral agreements with countries under the joint crediting mechanism. And with the formalization of the now coming into the second phase of the GX ETS, or their compliance scheme next year, they're looking to supply credits to meet the demand of about 100 million tons by 2030. And so some of the bottlenecks that I briefly mentioned before do remain around the capacity of countries to authorize credits. There's been challenges around corresponding adjustments and making sure that countries can still supply credits to the international market and meet their nationally determined contributions or their climate targets. But we're starting to see implementation on the ground in terms of the GX ETS setting its structure, outlining the next steps around setting a price floor and other mechanisms to operationalize that market next year. So this is a market that will both use J credits and also joint crediting mechanism project credits, and also durable CDR project credits can also contribute to this space as well. Next slide, please. And then for Singapore, we've seen not just in terms of their signed bilateral agreements, but we've also seen implementation in the form of procurement of credits. So they have procured credits from 4 projects this year, and they've recently, I think on the 31st, so last week, they published their second RFP for the procurement of credits, which has the deadline of the 31st of January for project activities to meet those requirements, to be able to issue credits that can be used as international carbon credits towards the carbon tax by tax set obligated entities under their scheme next year. Next slide, please. And then finally, just looking at the price movements, it's very clear that there is still the volatility that's within this market. However, in the past few months, we've seen more of a smoothening of those prices, apart from in one region, which is Oceania, which is mainly driven by the volatility of the ACU market and the prices. But all withstanding, we're seeing prices start to, I guess, maintain themselves. Europe has an average liquidity, average weighted price around $21 or $22 per ton. Oceania about $12. North America, again, about $12 as well, or 11.5. Africa, roughly under $7 per ton. South America, under $5 per ton, and then Asia, under $3 per ton, under 2.5. So I think there's still that that disparity, in terms of what the average liquidity weighted prices are in the market across the regions. And next slide, please. What is also very clear is that this is within specific market segments, and in particular nature-based removals. We're starting to see some of the optimism around high integrity in the market start to reflect in price. So across IFM or improved forest management projects, we've seen prices for avoidance projects in Europe reach about $60 per ton, 15 or so in North America, 14 or so in Africa, 8 and about just under 9 in Oceania, 8 in Asia, and 6 in South America. And then in terms of the removals, we're seeing Asia, lead the pack in terms of a $23.39 per ton in terms of prices recorded in those projects, which leads against North America's $21 per ton. So I believe I will stop there in the introduction to this conversation. We have been joined by Nilesh, who I'll allow to introduce himself, from Calculus Carbon, and he will walk you through the work that they're doing around de-risking this market and being able to structure capital structures that can effectively support this market. So over to you, Nilesh. Thanks for joining us.
Thanks, Fanny, for that. Thanks for walking us through the policy insights. I think very useful, particularly the developments around the compliance schemes in Japan, Singapore. Hello, everyone. I'm Nilesh. I represent Calculus Carbon. So Calculus Carbon, briefly, we are a financial intermediary. We've been around for a little more than 3.5 years now. We've seen a lot of activities over the last 3.5 years of our existence, but I think last 1 to 2 years have been particularly promising, and this particular year has been very productive for the overall market as well as for us. I think I could just quickly start off with the introduction briefly, and then we can jump on to the specific. We have 3 transactions lined up where we would like to highlight the emerging structures which investors across Asia and Europe are seeking within NBS in the global south. So hopefully that's something which could provide some additional insights. So yeah, let's get into it. Next slide, please. So briefly about Calculus, we are a Temasek portfolio company. For us, I think the mandate has always been to look at the NBS assets as well as businesses. So that includes project level financing as well as holding company level financing, which I'll kind of talk to in more detail in the subsequent slides. Our mandate has been to kind of act as an institutional market maker. What I mean by that is we are a financial intermediary. We sit in between the natural capital funds, which are the demand pools that's across commodity trading houses, corporate capital pools, natural capital funds, any financial institution who is looking to kind of either take anyone who is looking to provide institutional capital to large scale nature-based projects within the global south. And on the other side, we have project developers as well as business owners. So what I mean by that is I'll cover in the next few slides. Next slide, please. Our vision has been to kind of become the leading investment bank and the go-to bank as far as the natural capital investments are concerned. Our focus has always been to kind of provide clarity to the market in terms of what are the risks inherent in any particular project or asset being underwritten, and then which of those risks are underwritable by a particular capital provider and which ones are not. So then there are other additional ways to kind of go around it, including insurance and derivative pricing and so on and so forth. Next slide. I think when we started the mission and the theme to which we really kind of have stuck to has been an infrastructure lens. I think my background over the last decade has been in infrastructure and real assets. I think in my last role, I was an asset manager for a $2.2 billion real estate fund in Southeast Asia. I think for us, when we started Calculus Carbon, the theme was that nature-based solutions over time would evolve to become another subcategory of infrastructure asset class. You would have seen newer infrastructure plays such as data centers and movie studios with the emergence of OTT. I think nature and nature-based solutions projects, the large-scale ones, scalable ones at least, are similarly poised to kind of become a subcategory within the larger institutional bucket and their allotment towards infrastructure and real estate. And for us, I think the idea has always been to push the industry and to act as a actor in the market to be able to enable that. Three clear, I think, characteristics that we find in NBS, any NBS project, which are very close to an economics of an infrastructure asset. First is a useful life. So we've all seen with us, specifically on the carbon projects, we've seen a good 30-40 year useful life, which is what a project would get registered for within any of these larger registries. Second, there is a clear design, build, operate, which is the equivalent within the infrastructure space. Equivalently within NBS, we see a clear planning, construction, and operations phase. So there's the initial design period, and wherein you take up the feasibility study, FPIC, maybe even a small pilot. That's the design phase. Then you start with the upfront capex implementation, which is, for example, 10 to 20 million injection within any large scale project or forestry project. And then you have a very long life towards which trees mature and then we kind of stabilize post that. So each of them offer play for any infrastructure player or any investor right now in the market to be able to take a call as to which risk profile they would be willing to underwrite and accordingly take an exposure to the project in the respective phase. Next slide. Yeah, as I said, so we sit right in the middle. We've kind of expanded our network to include 34 natural capital pools of capital. It includes commodity trading houses, as I said, there's financial institutions in there. There are corporate demand pools as well as DFIs lately who have been getting very excited about the larger NBS category within the global south. And on the right side of it, we have project owners and business sponsors. Next slide, please. Yeah, so these are what we kind of exclusively focus on within NBS. I think for us, forestry, agriculture, as well as agroforestry, which is kind of a mix in the middle, have been the most active, though we've seen a lot of activities lately around conservation and ecotourism sub-asset classes within NBS as well. Next slide. Yeah, so I think I can spend a minute here and to the point that I was initially making around the two buckets of NBS demand as well as NBS supply. And this is how we kind of look at any particular asset, so to say, within the NBS space in the global south internally. On the left side, you would see capital providers, which typically have a mandate to do holdco level financing. So they are the ones who kind of look at mature top line businesses, maybe a top line of 50 million plus. And for us also, whenever we have gotten hired for the left bucket, it's always been equity or structured debt or long-term working capital financing towards any of these mature businesses within the global south. On the right side, if you see, I think these are more SPV level or project level instances of financing. So within that, you would see, I think the carbon has been the most significant mode of injection of capital at the project level, though we've seen a lot of activity lately around the equity financing as well within the SPV bucket, right? And you would see obviously fewer names such as Mirova on both sides because they have different pools of capital. Mirova, for example, has MSLF2, which is Mirova Sustainability Land Use Fund. There we are helping them raise a 30 million check on one of the mature 800 million top line businesses. So that's basically a very commercial sort of debt that's being provided at the holding company level to kind of expand their operations. On the right side, Mirova would have something like a CFN, like a climate fund for nature. This is kind of pooled. This is funded by corporate LPs such as Capgemini and L'Oreal's of the world, who would kind of take the credit delivery for their own consumption, for their own net zero usage, right? So you would see asset managers play to both. Few asset managers play to both of the themes, but within the NBS and the global south. But majorly, we've seen GPs take one or the two themes and then stick to it. So yeah, that's basically about the broader introduction. Now, I think what could be more interesting is to kind of walk you through 2 or 3 transactions. We have 3 transactions lined up. So next slide, please. I can just quickly get started with the first one. We can take any questions towards the end. These are the 3 of the most recent transactions we've covered, and I thought it'd be interesting to kind of walk the audience through 3 of these because each of them have a specific takeaway. So the first one here, we just received a term sheet last week. This is a $6 million in offtake financing within a large-scale AWD project. It's alternate wet and dry, which is a way to reduce methane emissions within the rice ecosystem, and it's quite prevalent within Southeast Asia. So this is a very you could kind of club it under a soil carbon project type. So it's an AWD project in Vietnam. The project developer, who is the client for us, it's a big Japanese NBS project developer. They have been in the market for more than half a decade. They have an extensive pipeline of 18 odd projects and have been very prolific within the Japanese market. Their mandate has been, and they are kind of also seeded, or they have balance sheets from large corporates within Japanese ecosystem. So I think here the deal has been that the structure has been such that the project developer in this case has been mandated to develop NBS projects within the broader Southeast Asia. And now with JCM as funding covered, like there have been 30 plus Article 6 agreements, so on. So what this project developer is doing is they are going to each of these host countries where JCM is already announced, and they're developing NBS projects. And their idea is to kind of get the credits back towards their Japanese corporates where they have an extensive trading arm, and to kind of use those credits for their own retirement within the JCM. Now here, I think, and then there's a broader theme at play here, and these projects are very of high interest right now in the market, where you have visibility on the offtake from a compliance scheme. So that kind of is one's way of underwriting the price risk, because it's a compliance scheme and it's a sticky long-term arrangement. One could probably be de-risked. An investor who is coming into the project is de-risked on the price side. Our mandate had been to kind of, on back of such a arrangement, provide provide upfront capex financing to kind of get the project to delivery or to maturity towards the offtake, right? So it's a 6.2 million capex financing that we've received a term sheet for. Now here the incoming investor, it's a European commodity trading house. They've been pretty active in the ecosystem over the last few years. Now, their mandate has been to kind of look at projects which have offtake secured. So they are not willing to underwrite price risk, which is the case here. And what they're only underwriting is the project's execution capability to get the project to the offtake level. On back of that, so essentially it's a financial investment with an IRR return. So the investor here, the commodity trading house, is not taking the delivery. The delivery would go towards the Japanese corporates within the JCM once the project matures. So it's one of those trends that we've seen in the last 2 quarters, where a lot of European capital providers are looking for assets which have secured offtakes, which are payment upon delivery. So the offtaker themselves are not providing upfront financing. So that kind of gives a room for other financial institutions and commodity traders and so on and so forth to come in and provide that capex financing, and kind of to meet the hurdle rate if they're able to kind of get to a hurdle rate depending on the geography. So Vietnam, for example, has a decently, I think, moderate sort of hurdle rate for European capital provider. So depending on different risks that are inherent in this project, they would be able to provide financing. So this is to that theme. Here, I think all the financing is being provided upfront. What's also interesting here is, for AWD, unlike in ARR, you would see the capital return fairly quickly, right? So if you kind of inject capital within year 1, within year 2 or 2.5, you could start getting delivery of credits. So I think um, for such, I think non-removal or avoidance, I think even IFM, I think, which Fundy covered in his introduction, I think those are the ones we've seen corporates who have a requirement in the next couple of years would kind of prefer those projects, especially if there's an offtake on back of it. Now, other thing to note is capital requirement is not as high as ARR projects for such non-removal project types within NBS. So that's also provides a limited bandwidth exposure to these capital providers. Yeah, I think that's all I had to talk about in this slide. So I think maybe, yeah, just a minute more. So here, like there's arrangement for an upside sharing within the compliance market once the credits go into the JCM. So because the capital provider is providing capex upfront, they would here kind of partake in the upside profit sharing. In case not, then the project developer, because they have a strong balance sheet, they would be able to buy back the credits themselves. So there's a backstop at play, and then there is a profit sharing above a certain price point within the JCM scheme. Yeah. So next slide. Also be cognizant of time. Transaction 2. So yeah, this one, I think it's on the similar theme, but slightly different. This project is a biochar project based in Argentina. Now, the theme is pretty much similar, where there is so offtake financing, I think, is something which has picked up highly over the last 2 years, last 2 quarters. Sorry. So offtake financing is nothing what I just explained, which is you have an offtake, secured offtake at the end of it, and then a capital provider would come in and provide upfront capex financing and make a financial IRR on top of it. So this is to that same theme, but slightly different in the sense that it's a biochar project in Argentina. So capex requirement is fairly substantial, though it's predictable, and the project execution risk is not as high as a particular typical NBS project, right? So here we've kind of here the mandate from the investor who we kind of got into the project is very interesting. And I wanted to kind of spend a minute there as to speak about the emerging pools of demand that we've seen in the market. So here, what the capital provider is doing is they are looking for a lot of these offtake backed projects in the market, which are all payment upon delivery, by the way, and they would kind of come in and provide capex financing, but they are kind of building a portfolio of such offtake backed projects, and they are doing an insurance layer on top of it, and this product is then marketed to different banks within Europe and UK, right? So basically, and then once they inject the capital or buy this product, the capital would in turn kind of go to the project directly. So that's another very interesting pool of demand that we've seen emerge on the mature banking sector, which is an insurance-backed, offtake-backed carbon project. So that takes away like two levels of risks away. One is on the execution because it's insurance-backed, and then also the price risk away because it's backed by an offtake. Right. So here we've again, I think similar to that for a biochar project, though, I think a substantial portion right now for any project is funded by the carbon credits. So here also in this case, it's 75% funded by biochar and 26% through sale of biochar itself. They had an offtake backed for both. From a major tech company for the carbon credits and from a large global multinational cement player on the actual biochar. Otherwise, I think structure is pretty much similar. I think here they have a short-term offtake LOI. They're kind of just wrapping out. It's a 3-year offtake, but then subsequent to more renewal, and the 3-year offtake would be for $10 million, and then there could be subsequent. Once the credits are delivered for those 3 years, but there could be subsequent short-term and long-term renewal of credits of the offtakes. Yeah, and they also have another ongoing discussion with another carbon removal financier who would kind of provide them an offtake for up to 50% of the total credit. So it's this project would yield 3.6 million, 360,000 tons over the next 10 years, of which for 180,000, they also are in talks with another carbon removal financier. So this again kind of takes away the pricing risk on the carbon credits, which anyways is going to fund 75% of the revenue over the next 10 years. Yep. The last one, which is a typical ARR project. I think this is what I think we've tried to crack a lot over the last couple of years, but these typically take the maximum time to close because of the inherent complexity and the level of risks inherent in any fresh or basically looking at a pre-funding of a ARR project in the initial stages. But it's a very interesting model that this particular transaction has given us. So we are in the kind of late due diligence of this project right now. Here, the capital provider, which is a European impact investor with US-based corporate LPs, their mandate has been in the market to kind of do equity transactions. So they would kind of infuse 20 to 30 million checks into the project level SPVs, and against that they would get returns in two ways. One is through carbon credits, obviously. So for example, if they do, let's say, a 50%, if the capital that they inject is to the extent of 50% of the equity in the project, for the 50% of the credits coming out of the project, they would partake in it. So those credits go back directly to the financier and in turn to the LPs, US-based LPs, who then retire the credits for their own net zero usage. The second is the financial return. So to the extent of the equity that they hold into the project SPV, they also get a commercial revenue from these ARR projects. So in this case, it's a commercial sustainable timber revenue. So here, to the extent of their equity, the financial return would accrue from their revenues, and they intend to make somewhere from 6 to 8% IRR over 15 years, which is how long they plan to stay invested in this particular project. So there's a return metric on terms of non-commercial revenue. So there's a financial IRR to it for their 25 million check, which is 6 to 8%, and there is a pricing target for the credits that they return. So in this case, it's $25 million, and that's pro rata for the number of credits. They're getting a 1.5 million tons over the next 15 years. So that gives a 25 by 1.5, which is $17 per ton. Their target is $20. So that kind of also fits the bill, right? So that's a way of evaluating a particular project in one of two ways. Or maybe both ways, which is for its non-commercial sturdiness as well as for its carbon revenue, right? So, and we've seen, I think, most of the recent demand come for projects such as this, because an ARR project, as I was, speaking to my earlier theme of any infrastructure play, because carbon markets are not as mature or as predictable as they need to be. Having a commercial line of revenue really kind of does wonders for a project, especially if they're looking for getting a larger check to the extent of 20 to 30 million. And we've seen an increasing demand from all the ARR financiers that will work in the Europe as well as in the Japanese and Singapore market for such project types where there is an inherent commercial revenue, either from some B2B or like white labeling of products coming out of the underlying trees, or from having a retail arm to it. But whatever, having a good multi-million-dollar run rate from a commercial source really does well for the project. I think as of last year, the theme was very different, wherein this would question an additionality of a project. So I think there's always a balance. Right now, the balance is more towards preference of commercial revenue alongside a carbon revenue. I'll maybe quickly stop there. I think I'm right on time, hopefully. Yeah. Thanks.
Perfect. Thank you so much, Neelish. And I know you have a lot of questions in the comments already. So what we'll do is we'll probably get to those questions at the end. So if you have any questions for either one of us, please keep sending them and we will make sure we have time to address them. Just to quickly go on from this, just as part of the structure of this webinar, we're also going to go into forecasting. So looking at what will the market look like in the upcoming years. And we've done some analysis outside as AlliedOffsets. So next slide, please. We have looked at where do we think reductions or removals will take place, geographically between now and 2050, with some surprising results. So we have seen, of course, largely in the medium scenario, a lot of these reductions will continue to take place in the global south. But in countries such as China and India, you see quite a large, proportion of that being concentrated. So about 3.4 gigatons of reductions, reduced or removed combined from voluntary activities will take place between those two countries. But then also in terms of Indonesia, we see 370 million tons, Myanmar 229, Cambodia 198, Papua New Guinea 83. The way that we've done our forecasting is looking at what is the market, what supply will take place, will come online, at different price points over time. So as the market prices start to increase, we will start to see more and more projects being set up where it's viable, commercially viable to set up a project. And that also incorporates willingness to pay for credit. So how sensitive are buyers to buying a credit, both now in the voluntary market, but also in the face of compliance market, prices as well that start to come online. So just again, continuing along that mark, the map. So Australia is looking to generate about 873 million tons in this scenario. Kenya, Ghana, Algeria, Uganda, South Sudan, and South Africa lead the way in terms of African project countries. And then we're also looking at Saudi Arabia and Turkey as well across the EMEA market. And then LATAM, we're seeing Brazil, Colombia, Argentina, and Peru. But this is for all project types. So we're looking at 14 different project types here. So there's also going to be a sway between the more technologically advanced projects having fewer credits versus the nature-based projects having higher, and so on. Next slide, please. So as mentioned, in terms of how we talk about, we factor in demand into this model. We're looking at where demand, the typical demand pools in the market currently. So it's CORSIA, and we've separated that from compliance, as that is the aviation industry has clear, targets in terms of the stages of that compliance market and how that will start to, look like over time. So we've separated them as a category. We also have future compliance, and there we're looking at compliance schemes such as carbon taxes and emissions trading schemes, and companies that we believe will be subject to a carbon tax into the future. We're looking at SBTI and non-SBTI companies, because for SBTI companies, we can see what the set rate is in terms of retirements against their targets. But then also non-SBTI, we assume that there will continue to be offtakes or even retirements of credits from projects, from companies without targets, effectively. So that's how we segment the four segments of demand for this model. Next slide, please. And one of the useful use cases for the modeling is, again, looking at where it makes sense to invest in a particular project type and where investors can start to see returns. So for ARR project activities, we are seeing that those returns are more front-ended. So we're seeing in the high scenario, much higher in terms of capital investment opportunity for investors at clearing north of 10 billion. And then we start to see that start to come down as we get further and further away, towards 2050. So the forecasting tool enables stakeholders to evaluate returns on project types across the different sectors and also across these different demand scenarios, and identify, high return geographies as well. Next slide, please. In addition to this, we've also been looking at Article 6 forecasting, and this is supply. And we're looking at that up until 2030 and then also beyond. And the way we have looked at this is we're looking at countries that are already engaging in Article 6 currently. So they either have set up designated national authorities, or in the case of Article 6.2 cooperative agreements, they have bilaterally authorized project activities already, and they have white lists on what project activities they'd want to see come to market. And we have modeled that out over time. So we started at around where the current supply of Article 6.2 credits is in the market to date, which is around 25 million tons. And then we started to model out what that would look like across the 3 different scenarios. And what we've seen is that ARR is seeing a bigger chunk or segment of that market after 2030 up to 2040. We're seeing agriculture projects also start to gain traction as well, and they've been listed in a lot of white lists, or they've already been authorized for approval by countries towards Article 6. And then we'll continue to see more tech-based removal start to come online much later on as the prices rise to be able to internalize those high prices for CapEx costs. So that's what we've done in this section. Next slide, please. And then similarly, we've looked at price trajectories for in terms of global averages over time. So we're seeing that for ARR, it continues to be a higher price than other project activities, and that continues to increase. But nature-based removal still remains much lower than your engineered removal, such as your direct air capture, your bioenergy, carbon capture and storage, or BECCS, and other project prices as well. So we are able to look at where these prices are meant to increase as they are the projects are able to come online effectively. So we've done some of that modeling as well. Next slide, please. And I think now, coming up to it, we have time for the Q&A. Nilesh, I have a couple of questions for you from the chat. So what I'll do is I will first bring one, maybe it's a 2-barreled question from George. So the first one is, how is capacity building for local communities, smallholder farmers, and IPs factored into pre-financing agreements to ensure local people are project partners, beneficiaries, and that there's some equity in the project activities? And then if I can quickly chase, so the second question is, what do you see from the investment side as the main barriers of policy and regulation to catalyze ability to move finance at scale? We'll start with you, and then I can take questions after. Yeah.
Sure. Thanks for that, George, and thanks for that, Fundy. I think so I think for us, because we don't typically get involved in the execution side, we kind of get involved mostly on marketing the project to the relevant investor, given the risks which are inherent in a project. At this stage, we kind of decide to represent the project. I think for us, we've typically started to get into a project and started to market within our investor network when they had all of the 4 things lined up. One is having a draft PDD in place, so that kind of gives one broad idea about the design and where the project is supposed to go. Then there is an FPIC, which is to kind of speak to the questions about smallholders and local communities. Because an FPIC is already in place, the investor coming in could make sure that that part has been sorted on the project developer side. Then third, I think there would be a requirement for a feasibility study, because then that one could relatively accurately predict the carbon outcome from investment into the project. And then fourth, maybe also a small pilot that also takes away some bits of execution risks, or at least an incoming investor has an idea about the kind of execution that they're capable of, the project developer is capable of. I think on the policy side, maybe I could just leave that to you.
Sure. Yeah, no problem. I was going to actually, the reason why I was forwarding it to you, because you mentioned hurdle rates in your first transaction.
Yeah.
It's interesting when talking about policy, tends to be looking at how does the market open up to be able to authorize project activities towards the capital investments. You mentioned price, that the certainty of price and how that is being used as a sticking point for demand. And I think that where policy can continue to open those channels, either through the cooperative agreements that projects countries can set up between themselves, but also the regulations that form the infrastructure for who owns the carbon rights, etc. And also what happens, in the delivery of the credits, how many credits are shared, between the different countries or kept towards the NDC. I think those can maybe be useful for investors as well. I was also going to ask you as well, I think there's a couple of other questions that have come in, so I'll try and spread our time as well. So Neelish, the first one is, in general, how are certifications for MMV or CO2 storage verification insured with these offtake agreements? I think this question might be speaking to also an insurance piece around delivery, but maybe you can shed some light there.
Okay, and how the certifications insured. Yep, I think the way to do it is to get registered within one of the market-wide accepted registries. I think that's the way we've seen the demand for these projects coming in only from certain reputed registries. And I think to add to that, the insurance which comes on top of it also prices that in. For example, in case one of the previous projects has delivered successfully and has been issuing credits to the extended date promise, I think insurance would take that into account when they kind of go out in the market and seek a pricing for one of the upcoming projects.
Great, thank you. I have one question which was for myself, which was, what do we mean by liquidity average weighted prices? So that's looking at all the prices that we get in. We're looking at how many retirements have taken place, and then what are the prices for those retirements. So if there's, let's say, 1,000 credits that have been retired at, say, $2, but then only like $10 credits have been retired at, say, $50, you're going to have a weighted average price between those to have a representation of the market. So we've done that. You can have a liquidity average weighted price at the methodology level, at the sectoral level, but we've done it at the continental level for the graph that we showed. But it is a way in which we are looking at these alongside our other investment, our indexes, as it were. So we have the AlliedOffsets 500, which tracks what is the general market sentiment in the market, and that's also an index of liquid average weighted prices across 500 of the most active projects, for example. So that might have been seen elsewhere if you've been seeing some of our data mentioned. And then there was a question of, where do we see carbon prices for different types of projects? Avoidance projects tend to trend on the lower end, so a single dollar per ton, whereas removals can be 30 to 40 US dollars. So we are looking at, the different market segments, including, let's say, for example, in Colombia, where the carbon tax rate has been capping the amount of credit retirements at the carbon tax rate at around $6 or $6.6 per ton. So you see that, and sometimes that can skew some of the prices that you're starting to see in those markets. But more broadly, we're looking at avoidance projects, and we are getting prices in for, let's say, renewable energy projects at around $3 to $4 per ton, or even less so. I think in some certain countries, it can be less than $1 per ton. And so you also see on the other side, removals can tend to trend much higher. For nature-based removals, it can be around the $25 to $45 per ton mark, depending on the geography. But when it comes to, again, the higher, integrity, or not integrity, sorry, the higher engineered or technologically engineered project types like direct air capture, you're seeing 3-digit, valuation of a credit. And that is one which we're continuing to monitor in this market. But the way that we are in this ecosystem is that we have price agreements. So we're able to also look at different prices as they come in, and also how they are distributed globally. I hope that answers your question, Jan. We have a couple questions for you, Neelish. I know we were kind of running over time slightly.
Yeah, I was trying to answer a few of those on the chat itself, but yeah,
yes,
happy to take a few of
I
those.
think what we could also do is record some of these, just in case if we don't get to them, maybe if you wouldn't mind, maybe sending an answer to one or two by email. I think that could be the way that we do this as well. So I think maybe there's one more for you, Neelish, and then maybe we can wrap up. So the question is, how would you characterize the state of the bank market for financing projects? What are the critical issues for bank financing?
Yeah, I think banks typically, obviously, it's hard for them to underwrite certain risks which are inherent in any NBS project right now. And I think the first one of the lot seems to be the offtakes. So unless one has a long-term committed offtake, which provides a stable source of revenue to be able to fund the the interest payments to be kind of paid back to the bank. I think it's very hard for someone to be to understand what's the so to say what's the leverage that a bank will provide on a particular project. So I think that's the limitation. That said, we've seen an increasing sort of interest from folks around UK. So there's Standard Chartered and a few others who've kind of come in, did try something around portfolio level financing for CDR projects and so on and so forth. But that market seems very nascent, and I think they are trying to see where they fit into the whole equation. But I think once someone, as I said, I think to my theme, the infrastructure plays how you could think about it, like the way you would look at certain large scale real estate developers being able to corner the largest amount of financing because they have the most track record to show in the market. We will increasingly see ones which have a widest or the oldest portfolio of projects increasingly being able to tap some of this upcoming financing from lower risk from higher risk averse capital providers such as banks.
Excellent. Thank you for that. And I think we may have come to time. So I just wanted to thank everyone for taking time in their busy day to be a part of this webinar. Nilesh, thank you so much for your contributions and your expert insight. And for all questions that we haven't been able to answer, we will be sure to follow up by email and be able to address those. So thank you very much for joining us, and I hope you have the rest of the day a good day.
Thanks, everyone.
Thank
Thanks,
you.
Frank. Bye. Cheers.
Thank you.